Let's type welcome Nimish ji. Thank you everyone. Yes, sir. You are good to go.
I hope the screen is still visible.
Yes, sir. It is visible.
Okay, great. Thank you everybody for this wonderful session. Thank you, Anbuji. Thank you, Ishwan Bhai. It was a great analysis and a great learning session so far. So this session is essentially on tranching. So I have spent some time in the community. I have spent some time as an investor, and I've thought about a lot of things. And I've tried to understand what is the edge, because definitely as a community and the process we follow in Technofunda has an edge. It is a persistent system that is able to generate index beating returns across market cycles. And um, so starting point is of course price action, but what I believe the heart of the process is tranching, because it takes care of some key fundamentals which I thought of sharing with the wider community. And so this session is totally upon it. And I like to call this whole process the art of tranching. And I have designed this presentation as a question, because I have asked this question myself multiple times, that why tranching, why tranching, why tranching? Because it is not very intuitive. It doesn't at first it feels not the right thing to do. So that is why I've created this presentation like that, and we will be sequentially one by one ask different questions regarding tranching, and let us try to find the answers together. So the first foremost thing is that why tranching? So to explain that, I would like to propose this theory called the bucket theory. So if we consider our portfolio to be like a bucket, so always the value of that portfolio is fluctuating because of majorly two reasons: that there is an inlet that is constantly pouring in value to the portfolio, and then there is an outlet that is constantly eroding the value. So this outlet is of course your all the taxes, brokerage charges, and it is also the notional losses and the book losses. While the value increases whenever the notional or book gain increases. So the portfolio is very dynamic in nature, and that's why its value keeps on fluctuating. Since the prices fluctuate and all these parameters are at play, so that's why even the value fluctuates. So tranching addresses the key problem of sealing the leakage, and also it aids in fueling in more water in the bucket. So if our portfolio is the bucket, tranching helps in adding more value to the bucket, and it helps in sealing the leakage. So I think that is a wonderful thing to do as such, because we cannot stop any one thing, but we can definitely change the velocity with which the value is being eroded, and at what rate the value is being added to the portfolio. How does it help us do this? Let us. That is what we precisely what we are going to explore in this presentation. The next question, natural question, is why tranching is counterintuitive. So, of course, I'm sure everybody, when we were introduced to this concept of tranching, would have felt that if I invest higher amounts, I will be getting higher returns. While if I invest low amounts, I will be getting low returns. So that is why it is counterintuitive. If I invest, say, 10,000 rupees and do a 2x, I will earn 10,000 rupees. But if I invest 50,000 rupees and do a 2x, I will earn 50,000. As simple as that. So when we have to break down a portfolio into so many tranches and keep doing all the process 1%, 0.25%, 0.5%, it sounds very counterintuitive that how can our returns increase by decreasing the position sizing or by investing low amount, because investment is the fuel of compounding as such. So that is why it is counterintuitive. The next question I'd like to explore is why iteration find multi-bagger. So this is a very, I'll take a very simple example of tossing of a coin. So investing is a game of probability, right? And we try to stack probabilities so that the output is in our favor, and we win more and lose less. And that is the whole game we are actually playing. But somewhere there is also a parameter of luck. Why that luck is there? Because the final output is not dependent only on the earnings of the company. It is also associated with the sentiment of the market. It is also associated with the demand and supply, with the macro factors, with the sectoral tailwinds, government policies, and all those things. It's a very complex mechanism that is happening in the market as such. So there is some sort of role of luck also in the process. Even if the chart pattern is perfect and it's a book like pattern, and we stack all our probabilities, still sometimes it will work, sometimes it will not, right? So I'd like to just consider a very simple example of costing of a coin. Suppose we take a coin. All of us know that the probability of getting a head and a tail is 50%. But if I toss the coin, say 6 times, will I be getting exactly 3 times head and exactly 3 times tail? No. Even if the coin is not a biased coin, still I might be getting 2 times heads and 4 times, and or maybe 1 times head and 5 times tails. On the contrary, if I simply increase the number of iterations, I toss it now 100 times. So the probability of getting 50 heads and 50 coins increases. So there is a small chart on the right side. So what happens is, as we keep on increasing the number of tosses, suppose we toss it 1,000 times, now the probability of getting 500 heads and 500 tails is very close. Like we might get say 497 and 503 like of outputs. So that is the key thesis here, that when we iterate multiple times, whenever we there is a an element of luck in the whole process. If we can simply increase the number of iterations, the role of luck reduces and the role of probability increases. So as an investor, luck is not in our control, but probability is. So that is why it is important to understand this thesis, that how iteration helps us find multi-baggers. So that is the key thesis here. And tranching helps us do this. We'll dive deeper into this. Next question is that why risk and reward matters and how tranching improves it. So whenever we enter into a company, there is a downside to it and there is an upside to it. Downside is risk, the upside is reward. And for increasing the portfolio value and for increasing the the probability of making a good profit in stock market, we need to, of course, reduce the risk and increase the reward. So when we take tranches and enter in smaller positions, that same 10% stop loss helps us skew this equation in favor of the reward. Because when we take 1% tranche, the maximum loss we can take in that particular position is 0.1%. But when we find a winner in our portfolio and we allocate it well, say to 5%, that has already compounded in the positive direction and it has now a multi-bagger upside or a multi-bagger potential, and we are allocating more to it. So now this 50,000 is becoming your 2x and giving you 50,000 rupees of profit, but that 10,000 rupees of first tranche was at a risk of 0.1%, which is 1,000 rupees. So by following tranching, we are risking say 1,000 rupees and we are increasing the reward to 50,000 rupees. So that is a crazy risk reward. And in fact, smaller the tranches, steeper will be this risk reward. So this is also very counterintuitive that, if we take a start at 0.25%, we will think that yeah, 0.25% में तो कभी 25% बनेगा नहीं, but it is not like that. Actually, if we start with tracking positions and do it well, or at least start with lower tranches, that is how the risk reward will be skewed in one favor. And when we do multiple iterations, it will help us increase the upside. Next question is why allocation matters and how tranching resolves it. So again, the same concept that disproportionate return is what we crave for, and that is what we are, behind. And for getting an index beating return, we cannot behave like an index. If we have say 20 companies in our portfolio, all allocated with same percentage, we might end up getting an index like return because our portfolio is behaving like an index. So if we have to beat the index, we have to again create a disproportionate portfolio, and that disproportionate portfolio will give us a disproportionate edge. And how can we do that? Again, tranching will help you do that whenever there is a losing position in the portfolio, we are starving it. We are not putting in more money at the table, or maybe we are also cutting it if the stop loss is hit. And even if the stop loss is not hit, we just let it stay there. And whichever position is working in our favor, we are feeding it. So tranching helps us do that beautifully, that we ride our winners and we cut our losers. And of course, pyramiding changes the game, right? Because I have given four examples of how one can pyramid. So the key thesis here is that pyramiding definitely increases our returns, and there are many ways to pyramid as such. In the first example, if you see, I have shown equal tranching. Say this was the stock price movement, and the stock gave a breakout here, and we took our first 1% position here. Then we took a second position here on newer high, and as the stock made newer highs, we kept on allocating equal tranches. So the average buy price and whatever the difference between the latest price, the difference between the latest price and the average buy price is essentially our return, right? So this also behaves some like center of gravity. If we consider these weights to be, different weights. So if they are equal, the center of gravity or the average buy price will be in the center. So that is what I've shown here. And if we do the classic pyramiding that we take steep, like very heavy bottoms, and then we taper it, say 2%, 1.5, 1 and 0.5% kind of tranching, if we follow. So heavier weight is at the bottom. So naturally, the average buy price will come in from here to here. It shifts down. Now, if I sell my position here, this pyramiding style has more return compared to the equal tranching, right? But there are more ways to it. Another way to look at it is reverse pyramiding. So these two concepts I would like to share with the community, that this is also a possibility. We often talk about equal tranching and classic pyramiding, but there could be even reverse pyramiding and asymmetric pyramiding. I'll explain what I mean by that. So in reverse pyramiding, what we do is when we are at low cheat, we are taking a very small position, say 0.5% or 0.25%. When we come at mid cheat, the probability is now more in our favor because there is definitely a risk of trap buyers here. Since the price has not yet crossed the pivot level, there is a possibility that the trap buyers or the Dukhi Atmas that we call these investors too, that we call these investors, they have a natural tendency of selling the stock whenever their purchase price is being met. Since these guys were on losses all the time, as soon as the price is starting to recover, irrespective of the growth triggers, they just want to break even and come out. So that is the risk here. So here the risk is higher, then the risk is lower. After breakout, risk is much lower. And when the stock gives a follow-up move, that means the pullback is completed or there is no pullback as such. And the market is probably re-rating the stock or there is a very strong earning expected in the next quarter. That is the typical case. So if you think about it, here the probability is low, here the probability is high, then it is even higher, and then it is even higher. So if we start at low cheat, it will actually make sense to stack our position size with the probability. So what we can do is we can take a very low, then slightly heavier, then even heavier. And when it confirms that Shaktiman has become C, there is a strong trend and the follow-up moves are great, then we can actually even take the highest tranche. And by doing so, since we started at low cheat, now see how beautiful it is that even though we have done a reverse pyramiding here, but just by starting early and following this process of stacking the probabilities along with the tranche size, our average buy price is lower than equal tranching. So this is one technique that somebody can test if they want to. Another point is asymmetric. Another kind of pyramiding is asymmetric pyramiding because this logic holds intact that as soon as the probability increases, we increase our position sizes. So what we do here is we take say zero point 0.5 and then maybe 1% or maybe say 0.25, 0.5, 1%. But after the breakout, now again we start tapering. So if this was say 1%, then maybe we take zero point 0.5 and then we take 0.25. So that was what happened. As the probability was increasing, our position size increased and when the stock started moving further up, we again started tapering. So it is like mixing of reverse pyramiding and classic pyramiding, and we end up with something called as asymmetric pyramiding. So essentially, the key thing to note here is that there are multiple ways to pyramid, and there is no right or wrong way. It is just that whenever we get the opportunity and we find an investment idea, we need to first understand where in the cycle it is. Is it at low cheat? Is it at mid cheat? Is it at breakout level? Is it extended? What kind of tranching or pyramiding style we need to follow? We just have to be cognizant that there are multiple ways to do it, and depending on that, we can take a call. So, like we were discussing, this further explains it that why position sizing matters and how to size for probabilities. So whenever there is a low probability, we take lower position sizes, and wherever there is a medium, we increase the position size. When there is a high probability, we increase it further, and we go all in when there is a very high probability. The ADX indicator is shouting us to add, is screaming at us to add, and we have a very good margin of safety as such, and the trend is clearly visible. The market condition is favorable. That is where we go all in when the probability is very high. So essentially, the position size of our transactions should reflect the probability, is what I would like to convey from this slide. Next question is that why we should prefer low volatility stock. A lot of times, even very high convincing bets and even when the growth triggers are very strong, still we tend to avoid these companies majorly because of one reason, that they are too volatile. Now, the issue with volatile stocks is particularly when we are tranching. So what happens is when we are tranching and the volatility is low, it is a very clean and very peaceful process. Add first tranche, it moves up. Add second tranche, then it moves up further. Add third tranche, and so on. But if there is a very high volatility, so what will happen is there might be very frequent entries and exits. And suppose we take three tranches, the prices started to correct now, and sorry, the prices started to correct. So what will happen is it might take our two three tranches from the top, and that way there might be a risk of negative compounding. So particularly when we are tranching our positions, we need to be very cognizant that we only choose those stocks which are low volatile. And high volatility does not mean high return. Please note this down. So even if the volatility is low, it ultimately the volatility is not a reflection of the potential of a stock to multiply, but it is simply a reflection of the liquidity of the stock. If the liquidity is low, it is going to be volatile. If the liquidity is sufficient or highly sufficient or like sufficiently high, there will be lesser volatile. So whenever we are following a tranching system, we should be cognizant that we should prefer low volatile stocks because big swings otherwise can reduce our real progress. Now, why does riding the trends matter? Suppose we add our positions, we took one, two, three, four tranches, and the stock was behaving well, and we simply sold it here. But the stock continues to move up. So what happens is that we are prematurely exiting, and we have, of course, reduced the risk side of our position because of tranching, but we did not keep the upside open. What we did is simply since it moved 30-40%, we think that there is no further scope for it to go further up, and that is why we exit. So that is a case of premature exit because of which we are cutting the reward. The whole game that we are playing is ultimately boils down to risk versus reward. And that is why if we have to have a disproportionate gain, we should ride the trend to the extent possible. Until there is a clear exit signal and until there is a clear shift in trend access, we need to ride our winners. So essentially, trends will create the wealth, and we have to very patiently capture it, even if there are fluctuations. But if the system is not triggering an exit, and if we have a good margin of safety, if we even if the notional profits are getting eroded, it is okay because giving up notional profits is better than making actual losses. And we have to keep the upside open. Only then it will make more sense. That only then we'll be able to find multi-bagger returns. Now, next question is that why exiting is essential. So, what we are doing essentially by tranching, we are taking our average buy price higher, right? So, when the trend is in our favor and we take multiple positions, what happens that each position starts compounding independently. This gives us some return, 15%, say this gives us 12%, this gives us 10% return. But when the stock price takes a U-turn and it comes back, so these tranches now start compounding in the reverse manner. And there is also a possibility of negative compounding. So initially, these three tranches are compounding positively. If we do not take an exit call, our average buy price is already higher, and there is a possibility of negative compounding. If the price comes down to initial buy price, say here, so this will compound negatively, this will also compound negatively, and this will also compound negatively, creating a very big loss in the portfolio. So even the losses compound is what I want you to derive from this slide. And accordingly, we should always be very strict in our exiting, particularly when we are foreign tranches. Because whenever we take an exit call, it is like we're containing that damage, right? And why should we backtest? Because even if we have a system in place. Still, emotions are not in our control, and every price fluctuation gives us certain signals of fear and greed. And because of that fear and greed, we might be making premature exits, or we might be carrying very big losses in our portfolio, or we might be missing the breakouts altogether. That we had it in our watch list, but we somehow could not enter in the right time, and maybe we entered late, because of which our overall portfolio returns are being compromised. So that is why whenever we are tranching, since it is a complex mechanism, because each tranche is compounding separately, so we need to maintain a journal, and we have to always reflect back that what was our tranching style, what were the wins, what were the losses, what were, and accordingly we have to refine our execution. And when we keep on doing this process, then we will end up with certain tranching techniques that suit our style. And markets always repeat. It is just that we have to repeat it with at the same time. We have to have a process that is repeatable, and when we are able to repeat the process well, that is where maximum amount of wealth is created. Next question is that why is tranching timeless and is it a superpower? So actually, if you think about it, tranching is a very timeless technique, and it is like a superpower because it works across the market cycles. There are a lot of techniques to invest and a lot of methodologies to be a participant in the market. Maybe coffee can investing, or say very active trading, or positional trading, and what multiple. You would appreciate, but if you think about it, one would appreciate that tranching is actually a timeless thing, and that is why it is a superpower. Because whenever there's a bull market, we add to our winners and we make the most of the bull market. We participate in full. Our whole portfolio amount is invested. They start to either stay there or maybe take certain corrections. And that way, since we are not getting new highs, we are not adding more money. If say 80% of the amount is deployed and the market becomes volatile, we do not add to our positions. We just stay there. So we were on the topic of what are moving averages and why do they matter. So whenever we overlay an exponential moving average or a simple moving average band, so they are like invisible lines on the watching. And whenever you see there is a trend in place, that stock price will be respecting some or the other moving average. Either the predefined moving averages it might be following, or even if we change the values, it will be definitely following some sort of moving average, and that is how it acts as a dynamic support resistance. So the point I want to derive here is that if we are able to understand that which moving average is being respected by a particular stock, and particularly this applies to satellite positions, if we are able to figure that out and we want to play very safe. So what we can do is whenever we are taking a new tranche, we can just quickly calculate our average buy price using journal or a simple calculator, and we can try to tranche it in such a manner and try to position our try to modify our position size in such a manner that our average buy price stays below that resistance line. I hope this makes sense, because suppose if you are taking one position then here, and one position here, so average buy price is somewhere here, right? Now, if the price has gone, say here, and I take another tranche, my average buy price will be somewhere here, but this moving average has already gone above it. So that way, it is like a very safe bet. Whenever I'm adding, my average buy price is below that resistance level. So most likely, at no particular given point of time, my position will be at a risk. It will always be in some profit, and that gives a lot of peace of mind. So that is why moving averages matter, and maybe we can try to tweak our tranching style even like that. If somebody wants to play very safe and at the same time make the most with tranching. Now, why patterns are important? So patterns are important because if the movement is very random, then there is a very low edge, because there might not be a trend in place as such. But if there is a structured pattern, like suppose like these kind of patterns, a cup and handle breakout or an ascending triangle breakout kind of things. So when there is a structured pattern and it is being supported, that breakout is being supported by very heavy volumes or institutional accumulation. So that way, the chances of getting a good trend in place are very high. And with tranching, we want that kind of trend, because only then our tranching is going to make sense. If we enter here, take first tranche, second tranche, the price comes down, and it is a very random movement, some tranches will be in profit, some will be in loss, and that will be there is basically low edge. So patterns increase the probability of trend. So one thing that all of us can follow is we strictly enter into a position where there is a very structured pattern and a very structured either base formation or a very structured kind of breakout supported by good volumes, because that will increase the probability of a trend. And when that trend is there, tranching will just help us make the most of that trend as such. Next question is that why should we see a chart on multiple time frames? So each stock behaves differently because of the kind of liquidity it has and the growth triggers it has. So when we see a particular chart on multiple time frames on daily, weekly, and monthly, what happens is that the daily time frames will have very kind of volatility will be high, and gain potential will be low. But when we increase the time frame, when we move from daily to weekly to monthly, so the gain potential will increase and the volatility will reduce. So when we are into lower time frames, the noise will be higher, and but when we'll be in the higher time frame, the reward will be higher. So that way, higher time frames require patience, but higher time frames have higher gain potentials also. So that is one thing that we need to keep in mind. And the balance of both is weekly. So when we have core like companies, we should most likely position ourselves on the monthly time frames. And when we have satellite kind of companies, we should focus more on weekly kind of time frames, and we should mostly be avoiding daily time frames because of this particular reason that there will be a lot of volatility and the gain potential will also be low. Right? So now the next question is that when we add in tranches, should we also exit in tranches? Should we trim say 10%, 20%, 30%, 40% like that? So the clear cut answer to that is no. If we are buying in tranches, our exit should be very strict and clear. If we are buying in multiple tranches, exit should be like one shot exit. Or worst case, it should be at least 50% exit, and then we can trim the 50% on whatever criteria we have set ultimately. Why I would like to dive deeper, slightly deeper into it, because when we buy a stock and when we sell it, there's something which is always followed is called FIFO, first in, first out. So we buy here, then we buy here, then we buy here, and when we sell, say one third of the position, this tranche will get exited. So this tranche made a good return, and it will show as a profit in your portfolio. But whatever is left in your portfolio, these tranches will show a very steep dip in the profit, or sometimes it will also show you very negative kind of returns. So that is why it creates a lot of confusion. Suppose if I buy here, then I sell here, then I buy here, then I sell here, buy here, and it's very staggered. So it creates a lot of confusion. Are we making profit? Are we not making profit? Sometimes we also become late in exiting. There is a chance of over trading because of which we'll be paying high brokerage charges, and our position sizing will also become very complex, and we might end up in taking wrong decisions there. So that is why we should be very clear in our exits, and it is preferred that if you buy in tranches, you should exit in one go, or worst case, we should exit in 50% of position. And even when we are taking that 50% exit call, always be cognizant that your first tranches will be sold first, and then make your calculations, and whatever is your subsequent exit strategy, just do a quick back calculation. If that gets triggered, what is going to happen to your position? So that way we'll be building more clarity, and it will be enabling better discipline in the portfolio, and this clarity will lead to better portfolio returns as such. The next point what I would like to explore is that why averaging up or down is actually a fallacy for the market. Now consider two examples. We buy first position 1% at 100 rupees, then we buy second position 1% at 120 rupees. So the average of both the transaction is 110 rupees. This is the case of averaging up. In averaging down, what do? We buy 1% at 120 rupees, then we buy 1% at 100 rupees. The average of it is still the same, 110 rupees. So the market will reward the difference between your average buy price and your average sell price, right? So market does not see what was the sequence of tranching. It will simply see what is your average buy price, what is your average sell price. That difference is what we're going to get. So market doesn't see the sequence. It just sees that 110 rupees. But why averaging up is a better decision? because we are trading in the direction of probability. When the breakout is happening, when stock is moving up, there is a high probability that it will keep moving up, and we are positioning ourselves in the direction of the probability. But when we are averaging down, we are going against the market wisdom, and we are becoming hopeful in a position while our average return is actually not guided. So that is why we should always avoid averaging down, and we should always average up in a portfolio. Only then we'll be seeing significant results. So all these things are actually counterintuitive, and that's why they deserve a deeper dive. Now, next question is that why tranching feels pointless initially. I'm sure everybody, all of us have faced this at some point of time, especially when we are starting. Right? So what happens is that there are a lot of breakouts happening, particularly when the market is turning. A lot of breakouts are happening, and if we have a 10 lakh rupees portfolio, we invest just 10,000 rupees. That was our, and that stock doubles, and we did not know how to tranche, and we just missed out on tranching at proper positions, and it doubled, and we just earned 10,000 rupees. So it feels very pointless that if I could have invested full 50,000 rupees in one go, at least I would have earned 50,000 rupees on a 10 lakh rupees portfolio. By following tranching, it is very slow, and I'm missing out on a lot of opportunities because of that, right? That is the initial feel. So initially, it feels pointless. But think about it. Initially, it might feel pointless that we are going very slow, market is moving very fast, and we are not going all in. We are just putting in, say, 5% of our money, then 10%, and eventually getting reaching the full 30% of satellite exposure. It requires some sort of time, maybe a couple of quarters also at times. But consider this: once we follow the system, and once we follow weekly charts, and we follow system to the T, and once we are fully allocated, then there is very low probability that all our positions will trigger exit at the same time. What will happen is eventually, if we have say six positions, or for say five position, if we have, what will happen is that whenever market turns, or whenever there is the growth is tapering in one particular position, exit will trigger only in one position, and we are invested in other four to five remaining positions. So that way, once we keep on doing this process and we spend sufficient time in the market, so we are already in, even after exiting one position, say we exit 5% of our satellite, we are still 25% already invested. So what used to feel missing out on opportunities initially is now, it is just the same. If the person is investing 30% in one go, or if we have built it over say 3 months, 4 months, the only lost opportunities of that initial 3 4 months, but that has given us a very good margin of safety. All our positions, our portfolio is like very defined. We have contained our losses, and whenever we are exiting, we are just exiting one brick of, or say one portion of our portfolio, and we are redeploying it in a stronger stock. So that is why it initially feels like that we are losing on opportunities. But once we keep on doing this thing again and again, and we follow the system to the T, we do not make premature exits. We wait for weekly triggers to guide us on our exit decisions. Then most of the times we are actually invested in the market as such. Now, the next point I'd like to highlight is that how does, or why does tranching align position size and the outcome? So now imagine this: if um, we are on a winning streak, our portfolio size will increase. Say for 10 lakh rupees, it has become 15 lakh rupees. So 1% of 10 lakh rupees is say 10,000 rupees, but 1% of 15 lakh rupees is 15,000 rupees. So when we are on a winning streak, even though we are following that same 1%, 2% kind of tranching, since our portfolio size is increasing because we are on a winning streak, our position size is increasing proportionally. Now, instead of betting 10,000 rupees, we are betting 15,000, 20,000. We are starting to take bigger bets because we are winning. But whenever we are losing, what is happening? If the portfolio value is now becoming from 10 lakh rupees to 7 lakh rupees, now our position size is reducing from 10,000 rupees to say 7,000 rupees. So whenever we lose, we will lose on a lower position size. So tranching aligns our position size and the outcome. If we are winning, our tranche sizes are increasing. If we are losing, our tranche sizes are reducing. So first of all, we were taking care of risk reward by tranching. And even the tranche size in itself is changing with the portfolio. How beautiful is that? So whenever we are wrong, We are draining because of the position size. Whenever we are right, that position size is increasing, and that way, in the longer run, it plays in our favor. And whenever basically the size is reducing automatically, whenever we are right, the size is increasing. As simple as that. Now, another feeling that most of the time we get is, suppose if the stock we were holding did a good gain and we exited it. We were fully allocated 5%. We were on a good notional gain. Say we were at 100% profit and we exited at 20% downtime. We booked an 80% profit. Now the stock reverses back, forms a new base, and breaks out. Now, can we redeploy that 5% again? We have to start with smaller tranches, say 1%, 2%. So there is a feeling that we have lost on that opportunity, right? Because we were allocated, say, 5%. Now we are starting with 1.1%, 2% again. So it feels again kind of pointless. But what we are saving on that time is that whatever that consolidation period was, it can be 1 quarter, it can be 4 quarters, it can be 4 years. Whatever that consolidation period was, we avoided that downturn or we avoided that consolidation and we invested in stronger stocks because of which our over portfolio size might have increased. And now the value of that 1%, 2% tranche is in itself increased. Suppose if we take an exit at a 10 lakh rupee portfolio value and we spend some, and the stock takes some 4 quarters to set up again. In those 4 quarters, if we are able to bring our portfolio value from 10 lakh rupees to 15 lakh rupees, now 1% of that 15 lakh rupees in itself is bigger. And if we are confident in the stock, we can also go with 2%, 2.5% kind of position. We can take low cheat entries and build strong position and keep our average buy price very near to pivot level. So that way, if you think about it, exiting might feel like a loss, but if we are following the system to the T, we are exiting and re-entering only at low cheat opportunities or breakout levels. So since we were invested in stronger stocks, our portfolio value would have increased, because of which our position size would have increased. And because of higher position size, we are actually uh, not losing a lot. If not making more, we are at least not losing a lot as such. So whatever the loss gain is, it is actually being compensated by the opportunity cost and the increased position size because of the increased portfolio size. That's it. So redeployment will grow capital, and now the re-entry percentage in itself will be higher in value. So if you think about it, tranching is actually a cheat code. Why? Because there could be only four outcomes in the market. We could either make small losses, or we could make small gains, or we could make big losses, or we could make big gain. So what tranching helps us do is it helps us avoid these big losses, and it helps us fuel these big gains. So it is like a cheat code that these transactions will net them off. We are restricting the big loss, and we are improving the gain. So going back to that bucket, I believe that now through all this discussion, we can be convinced that if we follow tranching properly, we are able to avoid the big losses and we are able to back our big winners. So that is a very powerful portfolio allocation strategy if you think about it. And that way we are closing the outlet and we are reducing the velocity of leakage and we are increasing the velocity of the input assets. So in a way, if you think about it, tranching is actually a cheat code and it is a superpower that we have. The next question is that what is the multi-bagger method? So it is a very boring method actually, but it works all the time. If even if have the best of sectoral tailwind behind us, even if have the best of management, even if we see very strong growth triggers, still there will be something that we might be missing, and there might be, and even if we are 100% correct, but the market's focus might be at some other place instead of what where our focus is there. So even if we do the best of the thesis, we use best of the AI tools, whatever we do, that Pareto principle of 80-20 will always apply in the portfolio, and not all the positions will always work in our favor. So, how to find multi-baggers in that way? What we do is we simply, take multiple tranches, and we using tranches we take multiple positions. Now, suppose if we start with 1% tranches and we have a 100% portfolio size, think about it, we have 100 opportunities to deploy our capital. But if we take 5% one shot entries, we just have 20 opportunities to deploy our capital. So whenever we have more opportunities, there is a probability of finding at least one multi-bagger in that portfolio, right? So even if the most clients stay quiet, so like this fisherman, what we are doing essentially is we are deploying our capital in multiple sectors, multiple market caps, multiple companies, depending on the chart patterns, the growth triggers, and all the fundamental analysis and the demand analysis that we have done through technical charts. And we are simply staying there, and we are not doing anything. We are just investing and we are staying there. Whatever works, we add to it. Whatever doesn't, we stay there. So whenever we find, and that is a very boring method if you think about it, because a stock will not become a multi-bagger overnight. It might take 2 years, 3 years, 4 years to become a multi-bagger. So we have to just keep on, staying in that position. And whenever we get a new high after 4 months, 6 months, 1 year, we just add to it. We stay there. We add to it. We stay there. So it is a very boring method if you think about it, but it always works because we are not fueling our losers. We are just feeding our winners. And whenever we find that one multi-bagger opportunity, we increase our allocation and we hit big by going all in there. So we are almost there at the end of this presentation, and I hope this was hopeful. So last thing, or maybe a few of the last things I would like to discuss is that how tranching helps with the mindset. As investors, it is very important to have a very strong mindset because there will be market volatility, there will be multiple cycles in the market. But even if we invest in the same stock, just by changing our position sizing and just by changing our tranching methodology, if we have a very big position and very risk associated with it, whenever there is a volatility, we will be, in big panic mode like this guy. What if it crashes? I have invested, say, 10% of our portfolio immediately. If that goes down, I'm going to take a big hit. And this guy will be in a lot of panic. But when we take smaller positions and we invest in tranches, ultimately we will reach the full portfolio size. He has also invested 10 lakh rupees. This guy has also invested 10 lakh rupees. He has invested into say just 5 companies. He's really worried about the market volatility. He has gradually built the portfolio. Each of the tranche has been taken such that the initial tranches, the reward from initial tranches is being able to mitigate the risk of the later tranches, right? And even if there is volatility, this guy is sitting peacefully because he holds 20 companies. Not all the 20 companies are going to fall. And he anyway did tranching. So even if he is losing, he is not going to make a portfolio level loss. At max, he will lose on some notional gain. And if he had invested 10 lakh rupees, instead of 15 lakh rupees of notional profit, he might end up at 11 or 20 lakh rupees of notional profit. And if he believes is a long-term investor, that cycle will turn at some point of time and even again be back at 15 lakh rupees or more of the profit portfolio value. So if you think about it, tranching really helps with the mindset and it helps us stay invested without any panic. And for just we keep on following the process gradually with discipline consistently. And that is why it helps because it is not important to just bet big in the market. It is more important. It is to stay in the market consistently. And if you're not getting killed just by being in the market, we can make great profit. So that is the key insight I wanted to derive from the slide message. So this is the final slide, and I named this presentation. And this is actually I'd like to share with the community. This is uh, uh, also a topic of my next book that I'm working on, and this is a work in progress point. These are work in progress points I wanted to discuss with the wider community and receive feedback, and also do my homework simultaneously. So why did I call this presentation or the book as a whole the art of tranching? And while it is very scientific, all the percentages are there, notional gains, notional loss, and all those things. So I like to call it an art because ultimately it is subjective. Whatever tranching methodology we follow, it is subjective and it ultimately reflects the investor mindset. If somebody is able to take high risk, they can have a different tranching style. If somebody is able to take lower risk or want to go very safe, they will have a different tranching style. So to bring the key point, we can take even 2.5% or say half allocation at one shot and then eventually build a 5% position. Or we can even start with 0.25% and eventually build or take from one start from 1% and build a position. It stops mattering after a time. Once we are fully invested, person A and person B both are investing the same portfolio amount, that 10 lakh rupees, and ultimately that 10 lakh rupees is going to go up and down. But somebody who has patiently built the portfolio with tranches will have a much peaceful ride, will have much higher margin of safety, and will have a much refined portfolio because he was able to experiment a lot of stock ideas. He was able to allocate to the winners, cut losses, and reduce risk. And person A, person B, both are ultimately invested with that same amount of 10 lakh rupees. So the person B who's following tranching will have a higher probability of finding multi-baggers because he is able to stay calm under all the market cycles, and that is where the multi-baggers are born. So thank you everyone for that patient listening. I still see there are almost 600 people in the room. So thank you so much for all that patient listening and all the love. And yeah, so that is everything from my side. Thank you so much, Anbuji and Vivekji, for this opportunity.
Thank you, thank you. Nicely and detailed explanation, Nimish ji. Nicely done, and lots of bulb on moments. Okay, right?
Thank you so much, sir.
Yeah, when you talk about different type of tranching, it is really a bulb on moment. I request everyone to type MPTY for Nimish ji.
Thank you so much, sir. Thank you so much, everyone.
Thank you, Nimish. Thank you.
Yeah.
Nicely done.
Okay, so I'll just stop sharing and I'll hand it over to you.
Yes,
Thank you so much, everybody, for that
thank you.
support.
Okay, thank you everyone. I think that concludes today's QMM. Okay, thanks for staying till this time. I think today we have a lot of learning from Nimish and learning wonderful insights from CCL products by Dr. Ishwaran. Thank you for all. Thanks a lot.
So just
Yes,
last thing, I was just going through the comments. Some people are asking for the presentation, so I'll share that link in the
yes,
group if somebody wants to refer it.
yep,
And also, this recording will be available in the Quantum Mastermind
yes,
calls access.
that's
And
true.
if somebody has particular doubt or have a counter argument or maybe want to discuss or give provide feedback, so I'm available on Telegram. I'm just a DM
There are
away.
a couple of queries regarding what the EMAs to use for satellite and what EMAs to use for core, right?
Yes, sir.
And yeah, if you want to cover, you can cover for maybe for a couple of
Also,
minutes.
sir, if somebody has question, maybe we can also have a small 5 minutes question and answer
Sure,
there.
sure.
So, I'm just answering that EMA thing, sir. We have Shaktiman with us. In Shaktiman 2.0, we have the EMA band. So instead of making the process complicated, we can just follow that. For satellite, follow weekly time frame. For core, follow monthly time frame. That's it. And it is a tweakable thing. We can set the intervals. If our stock is not following any of those EMAs, just see that how above or how below those EMS the stock price is moving, and we can tweak it and see for individual things. But most of the times, whenever there is a strong trend, the stock will be following some sort of EMA. We just need to find which one. And the standard settings have already been given by Vivek, so we can blindly follow those for most of the cases. That's it.
So actually, we don't want to generalize on any EMAs, right? So
Yes, sir.
let us go
Because it
for
also depends on the liquidity of the
liquidity.
company.
Yes. True. Thank you for that. Guys, if you have friends, if you have any other questions, please go for it.
And last request, sir, from to all the members. The key, if you really think about it, just think about it like this. When we are following tranching, we are building the portfolio in say 3 months, 4 months, 6 months. That is okay. We are in here for a long term, right?
Yes.
For 10 years, 30 years kind of horizon. So that is totally okay to give on that small time. But what tranching will help you do is it will help you stay in the game. And once we are able to stay in the game, compounding will take care of itself. The most important thing is not getting killed, and tranching will save you from that. So we are probably at an upturn. The market's probably turning. So henceforth, a sincere request to all the members: the easiest thing you can implement to safeguard yourself and for maximizing your potential of finding a multi-bagger is just following tranching. That's it.
Thank you very much. Yes. For better
For
clarity.
presentation, I've already answered. I'll share, and there was probably one question also. Hmm. Somebody was asking regarding the exit. So for exiting, my take is that we should take full exit. Either we should allocate in one go and then take, say, if there is a small cap company and say an SME stock, we have to invest a big amount, they say 2-3 lakh rupees. And suppose if for the portfolio it is say 20%, 10% of our allocation, but we still want to do it. Some people want to invest in SMEs. So that way we are already heavily allocated in one go. So
Yes.
when we are invested in one go, because we do not have any option. We have to do that. So it is okay. We did that. So when we did that, and now if the if it is possible and the company is now listed in NSE, for example, Beta Drugs. Say if we bought 2 lakh rupees shares of Beta Drugs and it got listed in NSE, if we have any doubt, now we can actually take partial exits because our entry was one. So
Yes.
we can stagger our exits. But if our entry is staggered, exit should be one. So either exit should be staggered or the entry should be staggered. For most of the cases, entry will be staggered. So it is better to exit in one shot, particularly in satellite. We can always re-enter. We can find next opportunity next Saturday, and that's never an issue.
True, 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 true. Very well said, Nimishji. Yes.
Some of the people are also asking the book name. So the book that I recently written is called Compounding Secrets, and this is the second book that I have started working on. This is called Art of Tranching. This will take some time to materialize, but Compounding Secrets is available, and for the wider benefits, sir, if I'm allowed, can I share the link also
Please,
in the
please,
chat?
please go for it. Go for it.
So I'm just quickly sharing the book link also
Please do that.
uh, in the chat if somebody wants to
Yes.
understand that what kind of thesis I've shared in that book. So it is available here. And I also took a session on the book in the morning in the book club. So that recording will also be probably there if somebody just wants to go through that recording, so they can in the book club meeting also. Next, somebody asking for the watch list that Vivek
Watch
sir has
list is
already
already
shared the
been,
Telegram.
Vivek sir already shared in the group. Can we take one live example of effective tranching from your experience and
Sir,
sizing as well?
can you name a script?
Yeah.
Or maybe if you want, I can also choose one.
You can choose your your latest 4x.
Okay, let us
That
take
is
that.
easier for us, right? Yeah, Power India is.
So if somebody has to really understand that how to when to add, so I would highly recommend there is a module of buy add sell system um, in the gold membership. Let us take first Power India, and I'll explain that. So of course, Vivek sir has covered everything in detail in Momentum Mastery module. But if somebody really wants to understand that what is the fundamental thesis behind the buy add sell system, so in the gold module, you get all the details about buying, adding, selling, and different indicators. He has explained different strategies using parabolic SAR and volatility stops and moving averages and how to take those decisions. So I'll try to simplify it with the chart itself. This is a core company, so we need to look at monthly chart. That is the first starting point, right? Second thing we need to do is we have to look at this chart.
Nimishji, you can toggle your watch list so that it can be full screen.
Okay, so sure, sure. So,
The next one. No, no. The
okay.
next,
Oh,
yeah,
sorry. Yeah,
take that one.
I think this is better, right?
Yeah, this is better. Yes.
Great. So particularly for this stock, this is a core stock. That is point number one. So the time frame should be monthly. Now, with monthly time frame, what we need not do is we need not look at the chart in between. Of course, now we have introduced that 15% rule. If that 15% follows that, we can trim 50% as per the system. But otherwise, see if we are following monthly closing. So take this example here. We can also explain that EMA thing. So there are three EMAs. This is fast EMA, slow EMA, and a slower EMA. See how beautifully Power India has been following the fast EMA, and in some cases it is coming back to the slower, the middle one, and it has never touched this EMA as such, slow EMA. Another way to look at it is the divergence. The fast EMA, medium, and slow EMAs are diverging. Whenever there is a divergence, that means there is a bullish pattern. Unless this trend changes, whenever the trend will change on a monthly chart, this blue will start coming below yellow, or even worse, below the red. But see how beautifully all these EMAs are above each other. So that way, the trend has always been intact for this company as such. The only premature exit somebody might have made would have been here because the price fell below the middle moving average. But if we would have simply followed the process, either during this fall we would have exited 50%, or we would have just waited there, waiting for the candle to close. So at month end, All this fall got bought in, right? And this ultimately proved became just a small consolidation, small base, and then again started going up. So coming to the original question of when to add, should we add here? This is all. This also has an orange dot, and this candle also has an orange dot. I'll zoom in a bit. Now, if you see these orange dots and flags, these are called solid candles. This is not a solid candle. This is almost a solid candle. This is a solid candle. Again, not a very solid candle, but okay, it is significantly higher. This is a definitely solid candle. This is not. This is a red candle. And similarly, we can just see which ones are the solid candles. Now, what does the solid candles, what do the solid candles denote? Solid candles, even though the stock price might look extended, but they denote one very significant thing, which is one-sided demand. So what happened during this month, or say these months? There were buyers and there were sellers, but buyers were so heavy that whenever the whatever was the starting price in that particular month in May 23, ultimately at the end of the month, bulls were heavy and they closed it decisively in their favor. That means there was a one-sided demand. So whenever this, just what you need to do for adding is whatever is your entry point. If there is a solid candle, blindly add. Why? Because here there was one-sided demand, one-sided demand, again one-sided demand. See, the falls are very low because there was one-sided demand. Again, one-sided demands. Then a doji, we have to be cautious. Again, one-sided demand. That means bulls were heavy. Then again, distribution phase, small distribution phase. Then again, bulls were heavy. So if we really have to, I don't remember, probably my buying price was say 7,000 rupees. So if I would have bought somewhere here at this level, it was not a breakout, but since it was a core stock, I still bought it here. And because I followed tranches, I was able to ride this move. Just because nothing rocket science actually, if you think about it. I added here, then I added here, then I added here, then I added here. And it since it did not trigger exit, I did not do anything. This was a tough phase for me too, because at this point, particularly at this point, my notional profit went down like crazy. But since I followed tranching religiously, I was never in loss. And since I was not in loss, I did not panic. I waited for the month candle to close. That saved me from the premature exit. And then the consolidation continued. And again, the breakout was there. Then consolidation, breakout, consolidation, breakout. So did I do anything in Power India? I did not do anything in Power India. I cannot because that company is being run by a separate management. Even if I want to, I cannot do anything about that company. What I can do is I can just follow my system. I can keep adding on wherever that one-sided demand is there. I can keep participating. I can simply follow the system. I know this company has potential. The earnings are growing really well. That is the primary reason that I chose this company in my portfolio. And it might have worked. It might not have worked. If it would not have worked, it would have simply gone out of the portfolio. Since it worked, I stayed in and it helped me. And I don't know if tomorrow an exit will trigger or not. It might happen that they do an excellent execution and it becomes 100x. There are stories of 100 baggers all around, right? We never know. Let's see. It might happen that next month I might exit, but if the exit is not triggering, I'll simply follow the system and stay. That's it.